Good afternoon, everyone, and welcome to all of our broker partners who are joining us on the webinar today. We thank you all for your continued partnership. It's hard to believe that here we are on December 9th and wrapping up 2021. It certainly has been an eventful year from the regulatory perspective, and that kind of takes us into today's topic, where we're going to be talking about the broker compensation disclosure requirements. So my name is Colleen Patterson, and I'm the Director of Employer Services and Compliance here at SAVOY. And I'm also joined today with Sarah Simpkins, who's on my team, and she is an Employer Services and Compliance Specialist here at SAVOY as well. So as I mentioned, we're going to be talking about the compensation disclosure requirements, and really, what are they? How do you have to comply? What do you really need to know, and when? And I'm going to preference this by saying we have some answers, but we don't have all of the answers, because there certainly is a lot that is left up to interpretation. But what we're going to go through are what the facts are that have been outlined within the regulation. So just to note, I am going to be making sure that I keep aware of the time, and I want to be mindful of everyone's time. I do recognize how crazy busy you all are this time of year. So we've allotted 45 minutes, and we've got a lot of material that we're going to cover, but we are going to keep a close eye on the clock so that we ensure that we allow enough time for some brief Q&A at the end. So I won't answer questions throughout the webinar, but Sarah and I will absolutely allow for some time at the end. So with that, as we always cover here on our webinars at SAVOY, is just a quick little disclaimer, just to remind everyone that the information in our presentation today should not be construed as any legal or tax advice in any way, and it's meant to be informational only. As we all know, this kind of information changes quickly because guidance is released continuously, except for this topic. Guidance has been a little bit vague and kind of missing, but Sarah and I are going to get into that a little bit more as we go through today's presentation. As always, with all of the information that we cover, please consult with your attorney or your tax advisor for any specific information as it relates to you and your specific practice. All right, so let's take a look at some of our objectives today that we're going to be going through. So we certainly want to make sure that we go through and understand what the obligations are under the disclosure rules. We want to make sure that you're becoming familiar with what the reporting process is, because the start of it is right around the corner already. And really to understand what are some of the pitfalls that you might run into when you're actually doing the reporting. And that's really where all of these Q&As are popping up, and trying to understand how to interpret these rules. So we're going to go through that today. So how this all came to be was through the Consolidated Appropriations Act of 2021. So that's, as we all fondly know, as CAA. And in that, it contained many policy provisions. It was a massive act. One of the sections that was in there, though, was this thing called a transparency provision that required brokers and consultants to now begin to have to disclose to their group health clients compensation that they would expect to receive. And then they have to also provide a description of the services that they provide in return for that compensation that they're anticipating. So that's what we're talking about here today. So what exactly does all of that mean, and why did this actually happen? So under the CAA, what really happened is that it expanded ERISA's existing disclosure requirements, which were previously implemented, believe it or not, back in 2012. It only applied, though, to the retirement plans at that time. So it didn't apply to all of us on the health and welfare side. So it didn't apply to health brokers at the time. Well, now it's caught up, and it does. So under the regulation, an arrangement, it's not considered reasonable unless the covered service provider, which the broker in this case, discloses its direct and indirect compensation. Now that term reasonable is extremely important, because under ERISA, any arrangement that is not reasonable is considered a prohibited transaction. So if it's not reasonable under the law, that means with that transaction being prohibited, the transaction being something like, signing your renewal paperwork, your contract for those services, and so on. If it's not deemed reasonable, then those transactions and those agreements become null and void. That's why this is so critical. The new disclosure requirements, they're outlined in the Act, and they really apply to contracts for services that are either executed, extended, or renewed. And this is the key date, on or after December 27th, 2021. Contracts that are executed prior to December 27th, 2021, they're not subject to the disclosure requirements until the renewal. So the big question that always comes up is, what does this mean for my January 2022 renewals? You know, all of the things that you guys have been working on for these last couple of weeks. So the answer to that question really is, it's going to depend on when the paperwork is completed. So if you execute the contract before December 27th, it doesn't appear that you'll have to disclose until the next renewal period. And that's probably, Sarah and I were just chatting before the webinar, that's probably one of the top two questions that we've been getting almost on a daily, if not weekly basis that's coming in. So our interpretation, as I had said in the beginning, there's not a lot of guidance other than the rules themselves that came out. Our interpretation is that if the paperwork is executed prior to December 27th for that January 1st, 2022 renewal, you do not have to disclose until the next renewal period. So beginning on December 27th, 2021, brokers and consultants have to disclose to group health plans their compensation if they expect to receive $1,000 or more in direct or indirect compensation for providing their services. And we're going to get into some definitions in just a bit. The bill actually defines compensation as anything of monetary value except non-monetary compensation valued at $250 or less. So non-monetary compensation could be a gift, for example. Generally, the definition of a group health plan, this is important to remember, and if we think back to all the things we know about ERISA, it's important to remember what actually defines a group health plan, and that is group health plans such as HRAs, ICRAs, FSAs, obviously the medical plan, except QSARAs. So the $1,000 threshold makes the requirement applicable in nearly all cases. The only exceptions could be the smallest groups, and that could be depending on the premium or the arrangement. The other thing that I want to make sure that we understand under group health plan definition is a group health plan is also a vision and dental plan as well. So it applies to, as I mentioned, the medical, obviously vision and dental, but again, the HRAs, ICRAs, FSAs, and so on. So let's not forget what we already know for the definition of a group health plan under ERISA. So we're doing a lot of talk about disclosures. So what do these disclosures actually have to include? And is it very specific as far as what it has to include? So there's a list of items here that I'm going to read through. And then a little bit later, as we get through the rest of the presentation, we're going to touch on different pieces of this through our discussion. So the disclosures have to include multiple pieces of information. So the first one is it has to have a description of the services that are being provided to the covered plan. It also has to include all direct compensation, including commissions. And what that means is a standard commission. We all know about contingent commissions, as well as any supplemental commissions. So anything that is under that commission definition has to be included. Also, indirect compensation, including compensation that's based on a structure of incentives that are set by a vendor or a brokerage firm. That doesn't include compensation received by an employee from an employer. So this is, what you would expect to be getting from a vendor or a third party. That has to be in there. Also, a description of all of the transaction-based compensation. So that would include things like a finder's fee, certainly commissions themselves, and any other incentive compensation that may be available for that particular product or service that you're providing to the covered plan. A description of the actual compensation that's payable in connection with termination, and if it's applicable, how any prepaid amounts may be refunded or calculated. So that's important when you think about moving from one particular product or vendor to another, always understanding what is the payout at the end, if there is any, because that has to be disclosed as well. And then if it's applicable, a statement indicating that the broker expects to offer fiduciary services to the plan. That doesn't typically happen, and it probably isn't going to apply in nearly all circumstances, but if it does apply, then it's expected to be included in the disclosure. And then the last thing that I just wanted to note here is that it also has to have a description of the manner in which these items will be received. That's also a requirement of the disclosure. So how are you receiving that compensation from the vendor and or carrier or third party that you are using for this particular covered plan? Okay, so one of the other things that we get quite often is about the calculations, meaning, what do we actually have to disclose and how do we calculate that number since we're talking about compensation? So the disclosure requirement, it's really all encompassing, and the descriptions must be sufficient for the client to evaluate its reasonableness. And there's that word reasonableness again, because reasonable is what determines if this is a prohibited transaction or not. So that's the whole purpose of why this information is being disclosed. It's so that the plan sponsor can evaluate the reasonableness of the overall program. It includes all forms of compensation, including standard, ongoing compensation, bonuses, finder's fees, prepaid and advanced commissions, payments made by third parties, could be things like incentive programs, and so on. So we've covered some of these things already. The compensation value can be expressed in the aggregate or by service as a dollar amount. It could be in a formula, it could be per capita charge, or any other reasonable method as long as a good faith estimate can be shown. So the broker must identify each payer and describe each arrangement. So let me just pause here for a second, because this is another area where we've been getting a lot of questions. And that is, do I have to actually give a specific dollar amount? And the answer to that is it doesn't have to be. It's one of the methods, but there's a list of ways that you can do that. You can show the formula as far as how the compensation is calculated. You can show the per capita charge, as I mentioned. But really what you want to be able to do is be able to provide the information that shows what the method was that was calculated for you to receive the compensation. And if that was a percentage of premium, if it's a flat dollar amount, all of the above are acceptable under the Act. In cases where contingent compensation can't be determined, and that is probably one of the areas that you're going to run into quite a bit, any good faith estimate with supporting explanations and the methodology that was used to calculate that, or any other assumptions that were used that were provided to come up with that number, as long as that is included in the description of the services, then that would also be appropriate for the disclosure too. So really the most important thing, and for all of you folks that have been on our webinars before, you've heard all of us here at SAVOY on the compliance team say all the time, the most important thing is to document, document, document. And this is no different. So you just want to make sure that you document the methodology that's used for you to receive that compensation. And that's the disclosure that you're going to be giving. That's the information you're going to be giving to this covered plan in this disclosure letter. So the other question that comes up is, well, what are these things called? Service providers, and am I really a service provider? So the new rules apply to any service provider that reasonably expects to receive $1,000 or more, obviously, which is also going to be adjusted for inflation. So I want to make sure that we all recognize that that number is going to change in the future. And also, if that $1,000, of course, is in direct or indirect compensation. So to answer the question, who are service providers, the list is pretty extensive, and that certainly can be brokerage services that are provided to a group health plan, and that is in respect to the selection of the insurance products. Benefit administrators and record keepers also would be things like medical management vendors, disease management vendors, absolutely includes pharmacy benefit administration services. Of course, it includes stop loss insurance and wellness services. The other things that you may not think of, though, are employee assistance programs, any transparency tools, and other vendors, compliance services, and group purchasing organizations that have any kind of preferred vendor panels. So the list is rather extensive, but obviously for what we're talking about today is we are falling in the category of brokerage services being provided to a group health plan with the respect to the selection of insurance products. So the majority of us are falling into that category. It also applies, though, to consulting services that are provided to a group health plan that's regarding the development or the implementation of a plan design, insurance, any other kind of insurance product selection, so any of that guidance, and the selection of providers for services that would include the record keeping, the benefits administration, medical management, and the other things that I had mentioned. So we have to keep in mind that this service provider definition is pretty broad. So then that brings up the next thing. Well, if we know what service providers are, then what are the covered services? For reporting purposes, covered services include, as I mentioned, the PBM services, wellness services, any of the transparency tools and vendors, disease management products, compliance services, again, the employee assistance programs, and so on. Most importantly, though, is that covered services includes the selection of the insurance plans, including health, dental, and vision. Because remember, under ERISA, the group health plan is defined as health, dental, vision, as well as the other plans that we had mentioned, which were like the HRAs, FSAs, and so on. We have to keep in mind that the purpose of reporting the purpose of reporting this is to ensure that the employer can understand the cost that are associated with the plan in order to know whether they want to engage in it. That's really what all of this is about. That's why we're disclosing this information. And really, again, it's for them to make a determination, is this reasonable to them? And reasonable being the cost of the plan and obviously the compensation that is associated with it. Because you're going to hear me say this multiple times because this is key. If it's not reasonable, then under ERISA, it is a prohibited transaction, which means that that transaction becomes null and void. So that's why this disclosure is important. So we have a couple more topics that we're going to go into, and I'm going to ask Sarah if she could take over for us here, and she's going to get into direct and indirect compensation. I think she's going to cover some timelines and some more information. So Sarah, you want to take it away?
Yeah, thanks, Colleen. So a question that's been coming up a lot as we're digging into this is, what is direct and indirect compensation? So direct compensation is paid by the group health plan, while indirect compensation is received from a source other than the group health plan, the service provider or the plan sponsor. So direct compensation includes amounts the plan has agreed to pay that are billed through an insurance carrier. And an example of this would be like commissions on premiums. So an example of indirect compensation would include a finder's fee and float revenue. So an example of like a referral fee would be the fee associated with a PEO placement, for instance. So that might not be something that's applicable to everybody, but it's something that's included in indirect compensation. So in terms of timing, there are a few different timing requirements. Brokers have to disclose the required information prior to the date the contract or arrangement is entered into, extended, or renewed. Brokers must disclose compensation changes within 60 days of being informed of the change. And brokers have to correct any inadvertent errors and omissions within 30 days of discovery. If there's a written request by the client, the broker has to respond to that within 90 days. And if a broker fails to disclose any of those things or refuses to disclose, the employer must request disclosure in writing. And if the broker fails to provide this after the deadline, the client must submit a formal notice to the Department of Labor within 30 days after the broker has missed their deadline. And I just want to reiterate again, if this requirement is effective December 27th, so if you have a group which is effective January 1st and you execute your contracts before that December 27th date, you're good to go for disclosure, but that might not be true for the entire year. Providing notice annually doesn't suffice for all of the broker disclosure requirements. So there can be situations where there's changes in your formula or your calculations, and you'll have to issue a new disclosure for that. So there could be multiple disclosures throughout the year. So brokers only have to disclose to the client, not to the Department of Labor, which is the good news. However, if the broker fails to disclose or refuses to disclose, again, the plan fiduciary, meaning the employer, is liable for a Department of Labor penalty unless the employer reports that failure to the Department of Labor, and they have to do this reporting in writing. So the broker may think, oh, my employer will never know about this, I'm just not going to do it. Your employer client may actually be liable if they don't report you. It should be noted, however, there's no specific way for employers to report this failure as of yet. It's just stated that they have to report that failure. So then again, the broker is subject to a penalty and any disciplinary actions related to their failure to disclose. So if a broker fails to report within the required time frame and the employer reports this failure to the Department of Labor, the employer is instructed to consider placing their business elsewhere, and the broker could see potential penalties under Section 502I. And I think one of the most important things to remember about this is that E&O policies will not cover these penalties. This is something that the employer or the broker is going to have to address on their own. So I think it's really important to just take a moment and touch on the next steps when you have these reporting requirements. So the first thing we can recommend is to prepare yourself. Gather all of your commission schedules and compensation information from all your carriers, determine what resources carriers may have available, determine where you'll document this compliance, and determine a point in your process where you'll make the disclosure. So you have to do it reasonably in advance of the contract. Of course, that's not specifically defined. So you should have a set policy of this many days before my contract renews, I'm going to give this disclosure to my employer. The next thing you're going to want to do is communicate. So make sure that you understand why you're doing this now, and make sure you talk about transparency with the employer and talk about the value that you're bringing when you present this to them. So if your employer just gets this and they see, you know, it almost looks like just a list of amounts. What is this for? Discuss that with your employer and make sure they understand what this is really about. And make sure you also have an appropriate disclosure format. So there's some templates available out there. I would say just make sure that you're meeting all of the requirements and make sure that whatever template you're using meets all of the requirements. And then make sure that you create appropriate communication around the disclosure. So again, that's making sure your employer understands why they're getting this, understands what they're supposed to be doing with this, and you know they can understand that it doesn't mean you have to actually do anything right now. You just need to keep this and make sure that you got it. And last, make sure that you implement all of these plans. So determine how you're going to deliver these things to your employers. Consider auditing your files to ensure compliance, and provide some training to your staff or certain administrators. So just make sure that your organization and your employer, everybody who's involved in this process, understands what's happening and then can put that into action.
One thing I wanted to mention, Sarah, because you pointed out some great information about carriers. So I did want to share with our broker partners that we are hearing that there are carriers that are starting to take some action to help broker partners with this information. So for example, Guardian will actually, I believe right after the first of the year, their quotes are going to start including what the expected compensation would be if you were to sell that particular plan. So, and we're hearing that from other ancillary carriers, and we do know that some of the medical carriers are considering something similar too. So the carrier partners are trying to do what they can in order to make this compliance effort with these new disclosure requirements a little more bearable for the broker community. So you may start seeing a slight change to some of the quotes that you receive after January 1st. And the biggest change would be the disclosure information of commission. So definitely keep an eye out for that.
Thanks, Colleen. And so in terms of SAVOY resources that are available, broker partners have access to commission information via the commission portal. Statements can be downloaded in an XML format, which can be really helpful if you want to put these things in your own format. In addition, carrier commission schedules for certain product lines can be found on the SAVOY website under carriers. And as we said, some carriers are actually meeting in the middle a little bit and providing more information for their brokers. A sample template for broker compensation disclosures can be found on our website. And of course, this template contains all of the necessary required reporting information as long as you fill out everything on your end. And helpful information will be noted on quoting materials and proposals coming up. So you can see there's going to be some changes to the information you can get from SAVOY in order to help with these reporting requirements.
Okay, and Sarah, it's your favorite part of the day. I know how much you enjoy the Q&A. So let me take a look here at some of the questions that we've received. So some of the questions it looks like I think we may have addressed, but let me just throw this out there one more time. So it looks like, Sarah, what's come in a couple times is the penalties for non-compliance, and I think you were just addressing that. So if we could just touch on one more time the penalty for not only what the plan sponsor may face, but then what the broker could face.
Yeah, so there's penalties. Essentially, the reporting process works like this. So your broker reports to your employer, and the employer can just keep that. And ideally, that's the end of the process. If the broker fails to report, the employer is going to be liable for essentially fiduciary penalties. So it really depends on the nature of exactly was the employer just blissfully unaware, or did they just say, I don't want this? So it depends on the exact nature of the issue, but it's essentially fiduciary penalties. Assuming the employer does report this to the Department of Labor, employers are going to be liable for a penalty under Section 502I. So it and again, that really depends on the nature of the infraction. So if it's somebody who intentionally disregards the requirement, the penalties will be significant. If it's a minor infraction, like they just made a mistake on their reporting, but they did do the reporting, or if they were a little bit late, then the penalties will be significantly less.
Okay, thank you. So another question that I see that has come in and asked in different ways, but essentially it's asking about a BOR takeover or if something just renews and there's no change. So a BOR takeover, it would be likely considered new business to the broker. So because it's new business, it's new compensation that you would be expecting to receive, then yes, you as the service provider, our interpretation is that you would have to disclose that in your own compensation disclosure because it's you as the service provider that's required to do that, regardless of what the other one did. This has to do with you. So to answer that question, I would say yes, you would have to do that. Now, taking that one step further, which is similarly to this question, is what happens with the disclosure if the plan is renewing as is and I'm not shopping it, I'm not changing the carrier or anything like that. So I'm going to preference this by saying that all of this, of course, in our discussion today is our interpretation of the information. There is no guidance that has come out from the DOL, nor are we expecting any more guidance because that's actually what the DOL told us, not to expect any more. So our interpretation, so when a BOR is renewing and there's no changes, we call that an evergreen policy, which just means it just continues, stay green, and it just continues on. Our understanding is that the best practice would be to provide an annual disclosure, or at least review the last disclosure that was done, because you also don't know if who you disclosed it to previously for the plan sponsor is a different person than what it is a year later. There's turnover that could occur. There could be a change in the compensation structure. As Sarah had mentioned, when that change happens, if it's during the plan year, the expectation is that you're disclosing it. So the best practice is at the renewal time, always review the last disclosure, even if you are just renewing the plan as is. Take a look at the last disclosure, who it was disclosed to, when, and how, and a best practice would be at least to do it on an annual basis. There's no specifics in the regs that says it has to be annual or not, but our understanding is that that would be the best practice for everyone to adopt. Another question that came in, Sarah, and I think you had covered this, so it came in a few times, is if SAVOY is making available a template. So do you just want to touch on the resources again?
Yeah, absolutely. So we have a sample template available that can be found on our website. So it's available for anybody who wants it, and you can just fill it in as needed to do all of your reporting. We're also going to be putting out some information on our proposals and quoting materials, anything that might be related to employer compensation reporting. That a broker would receive is going to be a little bit different. It's going to note all of these things that you're going to need. So yes, we have not only a template available, but we have a lot of other resources coming out as well.
Okay. And as Sarah was mentioning, that if you navigate to our website, there's a dedicated section of the website to this topic. So if you're using our knowledge base or our news regularly, the compensation information is actually easy to find because it has its own page on the website. So it's all collected there. So another question that has come up quite a bit, Sarah, and we've had some discussion about this internally with the members of our compliance team, is whether or not the disclosure requires a signature from the plan sponsor. So again, our interpretation of that is that the best practice is to ask for the signature. Now, whether you receive that back or not, I mean, who knows what the plan sponsor is going to do. There isn't anything that specifically states in the regulations that a signature is required, but considering that the plan sponsor is who could trigger the penalties to occur, again, our best practice is to request the signature. Now, the next question that always follows up with that is, well, can the signature be done electronic? In our interpretation, we believe that that's okay. So if you're sending like a fillable PDF that you've completed for this disclosure requirement and there's a signature for them to put that in there, our understanding is that that would suffice. And again, with all of this, the most important thing I think is to just document everything that you've done as much as you possibly can. Sarah, is there anything that you would add to that? I know we've had a bunch of back and forth internally about the signature piece.
Not much to add. I will say though, I don't think it's never happened before that you send something to somebody and it just gets lost in the shuffle and they don't even notice that it was sent. So having that counter signature where an employer is saying, yes, I received this, can go a long way if the employer does end up sticking their head up at some point and saying, oh, I don't think I ever got that. I should probably report that. So it's just a good thing to always have. Again, as Colleen says, document, document, document.
Okay, thank you. Another thing that I see that's come up several times is whether or not this applies to other lines of coverage, such as group life insurance, disability, and so on. So no, it does not. The definition of a group health plan under ERISA is group medical, dental, and vision, and then the other programs and plans that we mentioned, such as an HRA, FSAs, and so on. QSARAs do not meet the definition. So, and again, all of that specific detail about the plans that are under the definition of a group health plan with ERISA is also on the website as well. Okay, so another question, a couple questions about signature. Okay, so there's a question here about, can we point into the legislation where it will allow for renewals to be completed prior to 12/27 that can then be provided at the next renewal? So we can certainly, on our page on the website is links to the actual act where this is covered in the CAA. So it's there, but we can point you to the language that states that it applies to any contracts that are entered into, executed, or renewed after 12/27/21. So our interpretation of that is that for your January renewals, if you are executing that paperwork prior to 12/27, you don't have to disclose for the 1/1 renewal because those contracts were entered into prior to 12/27. Now, I think, Sarah, you may have mentioned earlier that doesn't mean for that same renewal that you won't have to do that throughout the plan year, because there are some things that could change. There's a possibility that the commission structure changes somehow. Maybe it's a sliding scale and you didn't provide the sliding scale. That would be an example of how that could change throughout the plan year. Is there anything else you want to add to that, Sarah?
No, I think that pretty much covers the extent of it. It's just, you never know, you can never truly be safe. So even if you have a contract, and this question came up recently, if you have a contract that's renewing during the year after 12/27, let's say February 1st, if you haven't executed that contract before 12/27, even if they're renewing as is and they're not making any changes to their plan, you should still disclose, just because they're renewing and they need to know that information to enter into this contract.
Okay, perfect. Something else that's come up a couple of different times is around the delivery, meaning is there any kind of a preferred method? There isn't anything that I can recall that I remember seeing in the regulation as far as what the form of delivery has to be, meaning whether it's an email, through the regular postal service, do you have to send a return receipt? There isn't anything that specifically points to that. Certainly, if you want to ensure that somebody received it, the best practice would be to use return receipt. That doesn't mean you can't send it electronically or through another format, but if you don't have a way to track it, it might be a little more difficult to document. So you have to just figure out your own best practice. But I do not recall seeing anything that specifically states it has to be delivered in one particular format or another. Sarah, I don't know that if you do. Do you recall anything either?
No, it doesn't say, although I would mention it might be a good idea to just try to adhere to the method that's reasonably expected to ensure receipt, which is something we see a lot when it comes to plan docs and notices. If you don't talk to this employer via email ever, you might not want to send it via email, and you
Great
might
point.
want to confirm that that's their email first if you choose to.
That's a great point. And one of the things that we've talked about a lot among our compliance team is, let's not forget what we know for other areas of regulations. And that's a great point. When you think about the electronic disclosure requirements under ERISA, one of the things that you have to do if you are a plan sponsor, so what the employer has to do, is they have to let everybody know ahead of time that they're going to disclose information via an electronic method, meaning they're going to deliver a plan document to their employees via email, or they're going to deliver annual notices via email. So that's a great point, Sarah, that one of the things you might want to think about when you're organizing things here is what is the delivery method based on your interaction with the client. And if you choose to deliver everything via email, then you're going to want to take the step to make them aware of that first to ensure that they're in receipt of the email and go from there. So that's a great point. All right, we've got some more here. So I'm keeping an eye on the clock as well. So let me just run through a couple of these other ones. Okay, this has come up a couple of times about broker penalties. Sarah just covered that earlier at the beginning of the Q&A. And yes, there is potential broker penalty if the plan sponsor reports it to the DOL and if the DOL then in turn does something with that. Yes, clients can also face penalty as well for failure to ask or document that they have received. So the penalty does apply and could apply, I should say, in both instances to a plan sponsor as well as to the broker. So it could be either way. Okay. No, we do not expect additional guidance from the DOL. Actually, we have been told from the DOL through our resources that they are not planning on releasing additional guidance. And they have pointed us to, in the regulations, there's a statement about good faith effort and interpretation of the information based on your counsel, your legal counsel and tax advisors. So when we have asked for additional guidance to address some of the questions about broker renewals and a broker of record renewals and so on, they have pointed us to that and said no further guidance is expected in the near future. Okay, let me see here, scrolling through a few more. Some of these we have answered.
Well, I just want to mention that, unfortunately, because there's so much gray area around all of these, regulations, right now, the answer to a lot of questions about what do I do if this and that, the answer is going to be do your best. And it's really all we can say.
That's absolutely correct. And one of the questions that came in here is, can a single form have all the benefits on it to show the carrier? So, and do you have to show by carrier, or can you show all carriers for the type of plan? So I'm wrapping up a bunch of the questions that have come in here. So our interpretation, as Sarah was just saying, is, and again, it's what your good faith interpretation of the regulations is as well. Our interpretation is that it has to be for the carrier or vendor or TPA, whatever it is that you're receiving compensation on that meets the definition of compensation, has to be disclosed at that carrier, vendor, TPA level. So you wouldn't be able to list all of the medical carriers, all of their compensation structures, and that is likely not to be in compliance because it does say that you have to disclose the compensation that you expect to receive from that particular vendor that provides that specific service. How you calculate that dollar amount, as we talked about earlier, there's multiple ways to show that, but you are fully expected to list the carriers, vendors, TPAs, and so on that that particular plan sponsor is utilizing, and that you are reasonably expecting to receive compensation as defined in the Act. Okay, let's see here. Okay, is there any group size requirement? No, this applies to all size groups. It also applies to fully insured as well as self-funding. So it's pretty much to everybody. Just to note, since that question was asked, there is an individual disclosure requirement too, but that's being handled by the carrier community on the individual side. But someone had asked, does it apply to any other types of products such as individuals? So there is a requirement, but the carriers are requiring that. And in our resources, in our article on this topic, it's noted in there as well. Okay, yes, we can make the slides available. That's come in quite a bit. All right. Timing, do I have to do this before and after the renewal date? There's been a lot of questions around timing. So Sarah, I think you touched on that before, but do you want to, for our last minute or two that we have, just a high level touch on the expected timing of when the disclosure has to be done, and then any timing around a change?
Sure. So you should always disclose before the plan renews. So before an employer enters into this contract, they need to have the disclosure. And then if there's any changes to your compensation, you have 60 days after that change, or you're informed of the change, to update those disclosures. And then if you discover that there's an error in your disclosure, you have 30 days from the date of discovery to issue a new disclosure. And if they give you a written request and they say, I want to see it again, you have 90 days to provide it.
Okay, thank you. This has come up a couple of times. So Sarah, I'll restate this for us. So again, if it is a January 1, 2022 renewal, if that agreement, the paperwork, whatever it is that needed to be executed for that January 1st renewal date happened prior to December 27th, 2021, our interpretation is that you do not have to provide a disclosure for that specific January 1 renewal. Now, if for some reason that is executed on December 27th or 28th, 29th, 30th, or 31st, yes, you would have to disclose. So if anyone has any other questions about that and you want to run through that a little bit more with us, certainly feel free to reach out to your SAVOY account executive and they can get on the, Sarah and I would be happy to get on the phone with you and run through that some more. I do see that we are at time and we do have some other questions here. So for any other questions that somebody may have asked we didn't address, we will reply to the questions, make sure that everyone gets their answers. As you digest the information that we went over today, if more questions come up, please do not hesitate to send them to your SAVOY account executive. Sarah and I and the rest of the compliance team, we will absolutely make sure that you get your answers that you need, but also remember that there is a dedicated page on the SAVOY website that houses this information. And yes, the sample disclosure under the resources that Sarah had mentioned, it is there for broker partners to utilize as well. So with that, we are over by a couple of minutes. So from Sarah and I and the rest of us here at SAVOY, thank you all for joining us today. And we hope that everyone has had and continues to have a wonderful holiday season. And if you are planning to join us, or if not, Sarah will be back next Wednesday. Actually, Sarah and I both. I think we're both on that one, Sarah. We're doing our end of the year recap for compliance, and we'll certainly touch on the disclosure. Again, if there's anything new that's come out, we will touch on that. So our next webinar is next Wednesday, and it's our end of the year compliance wrap up, and also what you can expect for 2022, because there is some things that we're keeping our eye on that are happening that will influence the early part of 2022. So be sure to join in. Thanks, everybody. Sarah, thank you so much. It's always fun when we get to do these together. And have a great afternoon, everyone.
Thanks, everyone.